Okay, Ryan here with James from Bond Street Mortgage. Today, we're going to do a quick realtor mortgage training. What you need to know about owner-occupant. It doesn't need to be just owner-occupant, but owner-occupied fixer-upper mortgages for the regular sort of people who are going to be living in the property, James. You do a lot of these, right? I'll let you get started. How many does Bond Street do of this type of product?
I would say hundreds at this point. We really, I thought after the crisis and the world of foreclosures and short sales that the renovation loans would actually slow down, but they've ticked up, and the primary reason again is 1991 inventory levels. So people are, baby boomers are retiring, they're moving out of state, and we have these older homes that need some TLC, so they are becoming more prominent programs again. So just spoke to a client yesterday buying a two-family, 440,000 house, needs some TLC. It'll be probably with 50,000 worth of work, it'll be worth 550, 575 when all said and done. So they continue to be a big part of the business.
Cool. So I have a couple of bullet points here. Why fixer rehab loans? The first one I have is just to find alternatives for existing buyers, or even help somebody decide to buy a house they might think need too much work.
Yeah, I think the biggest thing there is for existing buyers, and in general, I think we're all seeing it right in the real estate community too. A lot of it's kind of a mix of first-time home buyers. It's those second-time home buyers, and people looking for a deal on the investment side. So I'm saying, and I think I've been saying all along, the market has normalized. Residential real estate is back. So you really are getting a diverse client base. And, for the first-time home buyer out there, obviously the streamlined products are great because you can get up to $35,000 to fix a kitchen, fix a bathroom. So that ranch that I was just talking about that needs some basic things done to it that, pretty much anybody can deal, with a small reno type project. It's really a great alternative.
Yep. So if they're having trouble finding the perfect property, they see something that needs a little TLC, you as the agent can say, hey, why don't you just make the kitchen and bath here what you want them to be? I know about a financing program, slide them over to Bond Street and get it done.
I see it with talking to people buying homes and first-time home buyers especially. The renovated homes right now are going over ask. Everybody has to bid more than what the listing price is, and because everybody wants to move into that move-in ready home, they don't want to deal with the renovation. But just know that the person who did the renovation, and rightfully so as an investor, is going to get top dollar in this market, and therefore any additional equity that you might have had, you're going to just have to bid up on the property.
Yeah, I actually don't have that here as one of the bullet points, but it is a way for your client to get extra equity. That's a really great point. I'll put that in there. Okay, so the second thing I have, and this is near and dear to my heart, the rehab fixer loan, sorry, I'm having trouble with my drawing tool, is a sexy niche, so to speak, meaning that it's easy to use this hook, get a list of fixer-uppers, get a list, or how to get fixer-upper financing is a nice way to get people to opt into your database to get the info. There's a lot of buzz on HGTV, those other fix-up shows, and you will probably find from a pay-per-click perspective, you can get the clicks cheaper and the leads cheaper with this. And we do this in-house too, right, James?
Absolutely. Yeah, it is a great niche because of, like you said, obviously the HGTV world, but from, a business standpoint, I would say, it's great to talk about what's really happening in the marketplace is if, as agents, you're going after, obviously, listings, and you do have these pockets of the market that it's transitional, right? I always learned many years ago is that if you want to be successful in business, you want to look at the segments of your business where there's transition. Transition equals opportunity, and so where are people retiring? Where are they leaving? And again, that's where you're going to see the homes that need a little TLC. They're great homes. People lived in them for 40, 50 years. But they haven't touched them in 40, 50 years either. So if you're going after, those listings, really, if you're focusing in this area, it's a great pay-per-click, perspective, and it's different. It's not what a lot of people are doing. So the traffic and the cost is less.
Yep. In the process of doing that too, you might attract, I've experienced this myself a lot, you might attract investors who can then give you these types of listings. If you're out there generating leads around this idea, people are going to know you as a resource, and it could lead to good things in your practice.
No doubt.
The other thing, it's useful to know this information because you can provide value to your past clients. You can help them find renovation money on the refinance side, and also you can turn past clients into investors, which I think you do a lot of. You help a lot of people get the home style renovation in particular.
Yep, absolutely. You can borrow up to 75% of the purchase of the home and the renovation, which is pretty good leverage. We do have some new products that are kind of in that, it's not hard money. I don't deal with hard money, but it's kind of that in between, where rates are like in the sevens, which has been working very well for flips. Flips also can do flips in LLCs. So it's a fairly new product that we've rolled out. So it's pretty exciting. And I will say for the past clients too, is that, maybe you have those couples, maybe, like our generation, it's Generation X, late 30s, early 40s, and that bought their home 5, 6, 7 years ago, maybe are thinking about selling in the next year. As we know people don't typically wake up and say I'm going to sell my home, but maybe they need a little TLC before they sell or to unlock the equity in their home. And so if they have at least this, 6 to 12 month window where they're saying, hey, Ryan, check back with me. And, we're not going to do anything this year. We're going to sit tight. But next year, when my daughter finishes preschool, we're going to think about, maybe moving or something to that effect. That maybe it would help them having, getting some money to renovate the property and the upside be there, because you can show them comps like, look, this house just sold, but it's fully renovated. How can we go about doing that? And not just using the rental loans if they have equity. We have relationships that we can, offer lines of credits and things of that nature for our client base as well to help them get through that and unlock that value and have you go ahead and list the property for more 6, 12 months from now.
Yep. So one idea I'll bring up along these lines, a tactical thing you can use right now if you're watching this, just go ahead and email or even send a mailer to your past clients and say, hey, have you been thinking about sprucing up your kitchen or your bathroom? I know about some interesting financing options. And it might lead to, it might lead to more conversations that could lead to listings, just reminding that you exist in general.
Definitely. Great idea.
So let's go here to now let's break down these 3 types. I have FHA 203K, home style renovation, and then we can get into the other stuff. Let's start with the 203K program, James. I'm just going to kind of run through these bullets. What are the typical loan to value numbers that you can get approved for there?
Purchase plus rehab and put 3.5% into the deal.
3.5% down on the purchase.
That is your out-of-pocket investment. What the 203K does allow, though, is for you to go to 110% of the after appraised value to meet the budget that you have set. So it does allow for some discretion there, with the understanding that, from an appraisal standpoint, it is difficult to say that the house is worth X today, and with this amount of work, it will be worth Y. There is some subjectiveness there. Obviously, it is based on comps, but the 203K does give you that flexibility to go as as high as 110% of the total cost. Now, is that something financially that makes sense? I would argue probably not, but it is a case-by-case basis. Maybe you feel that you're moving into an area where it's there's a lot of upside, right? So that by doing that renovation, you feel, and by talking to the real estate professional, that it's an up and coming market, and that this home will be, here, look, this is what's happening. So we don't necessarily see that in appraisals because we're, looking at recent data, but the professionals in the community, we're happy to do a lot of business in areas like in Monmouth County, the Asbury Parks of the world, these areas that have, come a long way, and the surrounding areas are really starting to come, and get stronger. And so again, you're seeing properties that are renovated that are going over asking at this point, but maybe the 6-month data doesn't, reflect it per se. So again, it's really a preference, and we can talk about that if it's a good financial decision, and why you would be making, that decision to go a bit over what the after appraised value of the property is.
Got you. So I'm scribbling it down here live. It's kind of ugly, but I'm just in the example I have. You're buying a house, fixer upper. It's 100K is the asking price. It needs 50K of rehab. You can actually, and I actually have this wrong. You're saying you can actually borrow 96.5% of 110% of the after rehab value. You might even be able to say that the after rehab value is 170. Am I getting that right?
It would be the opposite. So let's say it is 150, but the after appraised value comes in at 140,
Okay.
or 136, So you could still finance that project even though the after appraised value comes in under the 96.5 total project.
Oh, that's when you would use the 110.
Correct.
Okay, I got it. So the 110 is for that case.
That's
Okay.
right. If the after appraised value, it comes in under the total project cost.
So let's just keep it simple. So if you have 100K purchase price, and you're planning to do 50K in rehab, you can borrow 96.5% of the 150, assuming the appraisal stuff works.
That's right. So even in this case, if the appraisal comes in roughly, like I said, 136 and change, or 135, call it, which is 10% of that total project 150 is 15,000. So it's right around that number. Even if the after appraised value came in that 10% lower than the total project cost, you'd still be able to get the financing for the total amount that you're looking for.
Got it. Okay, so let's talk about max loan limits. These mirror the FHA for each county. There's a limit set.
Yep, it is based on state and county. It varies based on the averages that are set by HUD. They were recently raised. For example, in New Jersey, the high balance limits were raised to 679,100 on the high end. And then you have, again, depending on the state in which you live, it will be driven on that. So I'm sorry, 679, 650 is the new high balance limit. And for example, in Bergen County and most counties, in northern New Jersey, will meet that what's considered a high cost area, and that's for a single family. 2 families, 870,000, 225. So, and it goes up from there. 3 units over a little over $1,050,000, and 4 family a little over 1.3. Now, on a 3 or 4 family, you do have to still meet that self-sufficiency test for HUD to finance a 3 or 4 family, meaning that the rents of all units, including the occupied unit, cannot 75% of those total rents. Cannot exceed the full pity payment.
Okay, so 75% of rents must cover, right?
Yeah, must cover payment, exactly. Great.
Must cover pity. Okay, so so you touched on a few things there. First off, those limits vary a lot. Like down here in Florida, we're not talking 800,000. It's going to be different wherever you are. So it's best to just ask somebody like James what the limit is in your county, where the subject.
Yeah, in Pinellas County, where you're at, the single families, 294, 515. So
yeah, it's a lot different. So just
it's a lot different. Yeah.
Yeah, just check with James. He knows a lot of areas off the top of his head. It's kind of freaky, but but he can find those limits for you if you're looking to make an offer. And it really comes in handy. I personally had a client recently where this idea entered the picture, and they discovered that by using the 203K, they could maybe make a little bit higher offer, or it opened up a different class of properties than they were even looking at. It kind of opened the market up for them.
Yeah.
To focus on. Now, up to 4 units, that's a key thing. You can do multis here. And again, that self-sufficiency stuff is getting a little nitty-gritty. Just know the rents need to cover pity. And again, that's going to be a James, or talk to your Bond Street mortgage advisor on the specific property to figure that stuff out. James, do you need to be a contractor, or do you need to use a licensed contractor for the actual work?
On the K, you cannot do your own work. Even if you are a contractor, you do need a contractor, other than if you do a Streamline K. Streamline K you do need a contractor, but not an inspector. So
okay.
On full K, where the work would be either structural or over 35,000 total, you do need a HUD inspector and a licensed contractor.
All right, so if structural or over 35K reno total,
correct,
you need a licensed contractor, and it needs to be and it has to be inspected by HUD, the work?
Inspector, yes.
Now, is it inspected at each phase of the project, or is it just at the end before you get the money?
Two different types of inspections. So the HUD inspector will go to the property, and I know from the real estate community, there's a lot of angst when people see, pre-approvals that are 203K. And, what I can say is what I've learned best from how to handle the process. It's okay to go out there with your contractor. Obviously, if you're looking at a property, you're going to make an offer. You're not going to pay for the HUD inspector to go out there at that point. But when the HUD inspector does go to the property, please have your contractor present. Your contractor is going to walk through the property with you and give you a quote based on the things you would like to do to the home. The HUD inspector is going to walk through the property and say the things that must be done to meet standard FHA HUD guidelines. So those typically don't jive with each other, right? Because it's little things too, like railings or, the HUD inspector may think, I've had this, situation come up that, the client didn't think they had to replace the furnace, but it was, from 1960. FHA says that the life of the mechanicals must exceed 5 years at time of purchase. So if the HUD inspector thinks that that is not the case, then you're going to have to replace those mechanicals. So to have your contractor there with the HUD inspector going over those things, so now your contractor can put those items into his budget and you can have that conversation on the things that you'd like to do, but you need to do, and the other things that you feel that you want to do in order to buy the home, they are in unison off the start. If that doesn't happen, it's a disaster.
So the HUD inspector, maybe I have this wrong. So the HUD inspector actually comes before the offer is made?
No. Once the offer is made, so that's why I say that your contractor will be there a couple times.
Okay.
And the issue though, because a lot of people will go out, look at a house with their contractor. Contractor says, yeah, you want to do this and that, it's $50,000. Right? And then you make the offer, you go under contract and say, okay, we're ready for the 203K. Well, now the HUD inspector goes and he says, okay, here's your contractor's estimate, but here's another $20,000 worth of work that I found that you need, that must be done.
The HUD inspection happens after it's under contract, but before settlement, right?
The HUD inspection happens right after you go under contract. Okay. Do the HUD inspector inspection, because the contractor estimate must match the HUD inspector scope of work. It doesn't have to match dollar for dollar, but the scope of work must match. They must match up. And then from there, that scope of work is considered approved by us as a lender, and then the appraiser is going to go out based on that scope of work, say this is what the house is worth as is, this is what the house will be worth based on the scope of work that you have, that we send to them.
So as a listing agent, there is some concern that the HUD inspector and the HUD inspector finds things that maybe you right. The HUD inspector can kill the deal.
Well, look, this is the way I look at it. I don't agree. As a lender, I want you to have, especially in a renovation type project, I want you to have a home that you are going to have no issues with long term. So the HUD inspector is there to protect us, but they also are shedding light on things that should be done or are mandatory, per HUD guidelines. So like I said, if the boiler is, about to go, and HUD inspectors, they understand the real estate community. They work with the contractor and the client to, get to the number that they want to, get to. But again, if something has to be done, they're gonna shed light on that. We don't want a situation where, that the hot water heater or the furnace goes and you just said, oh man, we just spent $50,000 on the renovation. I'm not saying the contractor's not going to tell you. There's a lot of good contractors out there that are probably going to point out what the inspector's saying anyway, and that's why I like having them both on site together, because a good contractor will say, that guy's right. You should do this stuff. You wanted to do the kitchen and the bathroom and the molding and all this other stuff that's going to make the house look great and the sidings and the windows, but you know what? For the extra $5,000, you really should replace the boiler. So. But the contractor may not look at that. There's, he wants the business. He's going to write you up the contract, based on what you are asking him to do. So that way they're really on the same page. The HUD inspector has a very good, strong, construction background. They're experts in this stuff. So they're here
Yeah.
to help deals. They're not here to kill deals. They're here to protect the client and protect us as the lender and making the right decisions with the renovation. And,
Yep.
the HUD inspector does come up with 20,000 worth of more of stuff that should be done or need to be done, then you're going to have to make the decision on that deal. You could renegotiate, is it if it's part of your home inspection, and that's why I say it does happen within the home inspection contingency period,
Okay.
because you do have the time to then go renegotiate with the seller for credits and try to rework the deal from that perspective, or say, look, we're getting a good deal. The extra 20 grand is fine. And that's usually what happens in my experience. That, people say, okay, look, we can finance 96 and a half of another 20,000. It's going to add value to the home. Why wouldn't we do it and have peace of mind?
Yep. So, and the HUD inspection is paid for by the buyer?
Yes, it is.
At closing or upfront?
Upfront, typically the HUD inspector will want a portion of the fee at the time of inspection. Then upon the completion of the report, they'll be paid the balance. But in the first draw, because that is a financeable closing cost into the 203K, in the first draw, the buyer will get that money back.
Okay.
If they so choose to finance
it. And the draws themselves, does the inspector have to come out each time to release the draw?
Yes, they do.
Okay.
No draws are released at closing. And that's something also that I always say you want to talk with your contractor is say, hey, you're going to do some work on this property. The bank is giving us the money. Here's everything. But, there is going to be an outlay to get some of the work started and going. And then you can, request a draw fairly quickly from there.
So the contractor becomes your partner. The contractor is motivated to get the stuff done because he's not getting paid otherwise.
Yep. And so however the draw schedule, that is set up right after closing, the draw schedule. And so whatever that draw schedule is, work is done, call the inspector, he'll come back out, sign off, make the request, and the money is issued to the contractor. The check is issued in the name of the contractor and the borrower.
So it's probably a good idea if you're a realtor to have relationships also with contractors who are familiar with this stuff. So if you can start to seek out, maybe build a small database of 2 or 3 guys have been through this before.
Yeah, we do as lenders as well.
You know people locally.
Under the 203K structure.
Yeah.
Some choose not to, but we do have a good database of, at least in our area, of contractors that understand how the 203K works and are okay with working under that framework.
So there's just a little tip too, because this is not something me as a realtor I would have thought, really given a lot of thought to. But if you're going to advise a client to go into an FHA 203K, also try to give them a contractor who understands the process.
That's right.
Right. Okay. Try to recommend a 203K friendly contractor. And it's also, if you know any contractors, it could be a good niche for a contractor to go into if they need more work. I'll tell my brother.
Yeah, absolutely.
Yeah. Okay. So let's see. Now let's talk about streamlined. It's going to be similar, but if it's not structural work, if it's just like kitchen, bathroom, there's the streamlined 203K, which is a little less heavy on the inspection front, right?
That's right. There is no HUD inspector involved. It's up to $35,000 for non-structural items, kitchens, bathrooms, flooring, painting, those type of things that you'd like to do to the house. Common things will not involve the HUD inspector. Again, using a contractor, they do have to be, licensed and carry the correct insurance, but it's a very much simpler process. Again, not that the HUD inspector causes too many issues because of the way we handle the K, but there is no HUD inspector involved, so you do save that money as well.
Would you go so as far as to say, I'm discovering here, maybe I have this wrong, but as a good buyer's agent, this should be something I should be moving toward, not away from, for lack of knowledge. Meaning, for my buyers, a lot of properties would benefit from this 203K process. You could provide a lot of value to your buyers by helping them improve a property that they're buying.
Absolutely. I mean, think about what $35,000 would do to the average home.
Right.
Just kitchen, bathroom, like I said, flooring, painting, how much value that would, unlock in the property, and how many properties are out there by just doing those things would, attract many, many more buyers.
We should be recommending this as buyer's agent.
No question.
And it's probably, I would guess then, a very underutilized program. Yeah. So
guys, yep.
What's that? Yeah, I'm kind of advocating here. Like you should be if the property's not 100% cream puff, you're not being negligent, but you're doing a disservice by not at least bringing this up if somebody's about to buy something that would benefit from another 35,000. With the streamlined, it doesn't need to be too much hassle, and any good listing agent who's willing to inform themselves shouldn't have much objection to this.
I always say, people are going to, the house is going to be priced where it's at for a reason, so if there are issues and, the house is sitting for a bit, we're glad to, put numbers together as part of the selling process so that when you are doing open houses or people are calling on that property to say, look, yeah, the house needs a little TLC, that's why it's priced the way it is, but here's our lender, here's a great option that is really seamless and will help you unlock additional equity by just using this type of financing and getting the property.
Yeah, you can simply close more. You can probably close more buyers faster with this too. How funds are dispersed? We touch upon the inspection. Let's talk about, so in the regular, the funds are dispersed as you complete work, right?
That's right, and the streamline as well. Okay. Typically, the streamline is not more than 2 draws because of the dollar amount.
Oh, okay. So the regular, as work is completed and it's approved, it might be how many draws?
Might be 4 to 6 draws on the depending on the size of the rehab. We've done considerable rehabs where there have been five draws or so as part of the regular K process. Streamline typically is no more than 2 draws.
When are these draws decided up front? Is there like a plan built before the?
There's a draw schedule that is set up between the contractor and us as the lender and the buyer. So we work on that together, and that's signed off on as part of the process of the mortgage.
All right, complete a draw schedule, right? That's what you called it. Draw schedule as part of the commitment process, right? Mortgage. Okay. Okay, streamlined, and with streamlined, it's a little less involved, but it's very similar. There's just less draws.
You got it.
Okay, so James, I just learned a ton myself. I feel like I've been negligent for all these years for not learning this stuff, but truth is, this information is just not really out there in the marketplace. Nobody's ever told me as an agent to learn this stuff, or hit me over the head.
Like I said, most people hear FHA or 203K and they run.
Right.
And if you're working with the right lender and you have the right team on the lending side, you hit it on the head. It's something that should be promoted more.
Yeah. So let's go ahead, just in the interest of time, I'm going to rush you through into the home style renovation, which is is an FHA program?
Nope, Fannie Mae.
Oh, Fannie Mae. So loan to values there, and I know that this can be used for refis too, right?
Yes, and the Ks can be used for refis as well. So the main difference here is the home style is the Fannie Mae answer to HUD's 203K. It does allow 1 to 4 unit financing. It does allow there's 2 programs here, home style renovation. Fannie Mae has a first-time home buyer program called the Home Ready program. You could use those in unison and finance up to 97%. The only thing with the Home Ready is, unlike FHA, is that it does have income limitations. So depending on where the property's at. Otherwise, we can do up to 95% financing and without income limitations on the home style renovation loan, up to that same 679, 650 loan limit. And so the advantage of the home style renovation is that it's a conventional loan. So if you have better credit scores, where the FHA you do have a higher APR because you are paying the upfront mortgage insurance premium of 1.75% to FHA to finance the insurance part of it, and the monthly mortgage insurance is as high as 0.85%. If you have a better credit score, PMI comes from the private market, so that monthly amount is less, and you don't have that 1.75. So it is the conventional answer to the government answer of the 203K. The only thing with the home style renovation loan that's different than the K and the home style, the renovation cannot exceed 50% of the after appraised value.
Okay.
Whereas on the 203K, you don't have that limitation. So in the example, you're buying a home for $200,000, okay? And the home is going to be worth $350,000. The work cannot exceed 50% of the after appraised value.
Right, of the 350. 170.
Correct. So
So
which is 175 in that case.
so this is more of a renovate. Yeah, it's more of a renovation instead of versus like a complete gut rehab or something. Yeah.
On the K, you can literally, a rehab is considered leaving one existing wall. You could do
Yeah.
that with a K. On the existing foundation, rip the house down, leave up a wall. You can do that in a 203K situation. On the home style, as long as that doesn't exceed the 50%, you can do that as well, because it does happen where you buy a property, maybe for 200, and you are going to knock it down and leave up a wall, and it's going to cost you 300 to rebuild. As long as that after appraised value is 600, you're still okay.
Got it. And so the max loan limits are the same.
Yep.
Again, multifamily is fine.
Multifamily is fine for owner occupied. Yep. 1 to 4 family.
For owner occupied. And you just brought up a point there. You can actually use, now with the 203K, that you cannot use that as an investor. Do I have that right?
Correct. Only owner occupied. Yep.
Now with the home style, it is you can actually use this as an investor.
And second home.
Investors and second homes.
Yep.
So I'm an investor. I see a property that needs a lot of work. I plan to flip it. That's okay.
It is. Yep.
And I can borrow 95%, go up to 95 LTV?
75%.
75.
Yep. Only single family or condo, not multi.
Single family or condo. Yeah, this is a really viable, and this is a viable option for investor funding that I almost never hear talked about either.
Absolutely. Or you want to buy that beach house that needs some TLC. It also works. Obviously, unfortunately, we had still dealing with remnants of Sandy, or again, areas where things are up and coming and the house needs a little bit of work, and you want to go in and buy the second home in that area. It's very useful.
So 75 LTV of the ARV of the after rehab value.
75 LTV of the total project cost. So buying for 150,000 worth of work, it's 75% of the total project cost.
So this blows away. I mean, so many investors out there using hard money.
That's right.
Typically, hard money you're looking at, they'll go 65% of the ARV, right? Yeah. And charge you like 10 points. Well, it's like 6 points and 12% interest for 6 months.
Yeah, well, we actually do have also an investor, because a lot of investors don't, in this situation, that the home must be in your name personally. So a lot of investors like using LLCs. You can't use home style and put the property in LLC.
Gotcha.
We do have, I'm going to call it semi soft money. It's really not hard money, just like you mentioned, that goes to 65 LTV. Rates are like in the 7s, maybe 2 to 3 points. So it's definitely a good alternative to hard money as well.
Okay, so you have yeah. So to begin with, there might be some investors who would benefit from using this instead of their usual funding sources, depending on their situation. Otherwise, you have stuff that falls between this and the hard money.
You got
it. Okay. I'll get rid of this. Need to be a contractor. This is all the same. Is it the same kind of inspection stuff?
No. A HUD inspector from our side isn't necessarily needed. It's based on the size of the project as well, but it's not about the $35,000 threshold. It really is more based on the overall deal, and if we feel as the lender, the inspector would need it to be involved. Like, for example, you're a first-time homebuyer, you're going for 95 LTV. It's going to be a 200,000 renovation project. We are going to require our inspector to be involved, again, to make sure that you're being protected as the buyer and us as the lender, to have, quote unquote, someone from our side, that boots on the ground, to see what your contractor is charging you for. The inspector really is there to keep your contractor honest, and
right.
Also point out deficiencies that you really should be thinking about when buying that home.
But if you're kind of a little more seasoned, this is up to the lender. You're saying, like, you could decide that the person the buyer has a lot of experience. It's a low risk project.
Yeah.
And you don't send the inspector.
Yes, and the home style does allow, if you're not the borrower, as long as you're not the borrower on the deal. So if you're going to buy the property in your spouse's name and you're a contractor, that is allowed in a home style situation, where it's not allowed in a 203K situation. So
you can do your own work as a contractor.
Yeah, as long as you're not on the mortgage, as long as you're not the one borrowing the money.
Okay.
So on the investment side, it's you and a partner. You're going to put the loan in your name. Your partner, even though it's a related relationship, can be the builder.
Okay. Okay. I'm just writing partner as contractor.
Yeah.
Kind of as a side note. Okay, cool. So again, another highly underutilized program. If you have any past clients who want a new kitchen or bath, they can go ahead and do a pretty easy refi here to get the money, right?
I do want to point out with the home style, because I see this a lot. Property, I'll see it in the listing. Property must require, in order to offer to be accepted requires 203K. That I don't ever see anyone mention the home style renovation loan.
Okay.
It really is, like I said, and I also talk to many people that say, oh, we were shopping around and we saw your, advertising online, or you were referred by somebody, and, somebody said we needed a 203K. And then we go through the pre-approval process. They have excellent credit. They have the 5% to put down. The home style is a much better program from the conventional side. So, it's really underutilized from that perspective. Everyone thinks renovation 203K. It's really the great conventional alternative to 203K.
So that's one way to put it in your head. The 203K is the kind of the FHA option.
Yep, home style is the conventional option.
Okay, good. Okay, let's go really quick here. This is a really good deep dive. Let's just go into those other types of fixer funding that you might have available, James, that you see in the market.
We do have a kind of a wide range there. So, like I said, there are the fix and flips for the less, let's say, credit-worthy person or less experienced person in the fix flip market that you can get up to 65% of the total project costs. We have, great relationships at the local level with commercial banks that will do larger projects renovations like multifamilies, condo buildings for rent, that type of thing. So it really, when we're dealing on the investor commercial side of it, it does become very specific to you as the individual investor. What your experience is, what your personal financial statement looks like, the size of the deal. There's a lot of different factors, and that really is a one-on-one consultation. And
right.
We will go find you the money depending on the project. So I'm literally working on, $300,000 projects to $7 million projects. So it really varies, based on the specific needs and balance sheet of the investor.
Some videos with the home style renovation. You can share these on social media. Embed them on your blog, things of that nature. And then, James, we have a whole page on our site for agents with lots of other videos like this, other resources.
Yep.
Right here.
And again, I would really say from the investor standpoint, because we're talking to more and more people about it. And again, to me, it's a healthy sign that people are looking to get, because people say, oh, here we go, all this crazy financing again. And, we're going to go through what we went through. And it's so untrue. Again, we're talking about 65 LTV, maybe as high as 75 to 80 LTV if you have experience in the field. There's no 100 LTV we're talking about here, like in 2006, or somebody that, literally just decided to, get into the fix and flip market. It really is about you as an individual, your balance sheet, your resume, where we're able to bring that money to the table. So for me, it's exciting, and you can be a new fixer flipper, but don't think that because you just have a little bit of money that you're going to get into market. You do need some good credit. We are going to, again, look at the balance sheet. We're really going to make sure that you're ready to make that investment. I'm more than happy, and as a company, we're thrilled to work with those type of individuals. It's an important part of segment in the market, and I've been a big proponent of needing more of this product available. So it is coming available, and it's exciting. Again, inventory is at 91 lows, so we need more good inventory on the market to help, and I think more buyers than we've ever had since '99. So we need more inventory to make get these buyers into without having them overpay. That's the situation that probably makes me more nervous, is to start overbidding and trying to get ahead of the market. And again, that may be fine in certain areas that are up and coming, but you don't want to overbid in an oversaturated market. That's we learned that lesson.
Right. It's the opportunity for real estate professionals to provide a real service help your clients use these programs, and it provides a real service and efficiency to the market itself.
Even yourselves as realtors, you're looking at a house out there, man, you know, if I had some money to buy this house and fix it, I can make some money. Give us a call. I'm more than happy. You know, a lot of the fixer flipper products that we're talking about, especially at that 65 LTV level, we can do nationally. The home style reno we can do nationally, and again, at the, you know, on the local levels where we have you know, our business, we also have plenty of commercial banks that have products available for you.
Yep. So I put some information here. We have our main number here for Bond Street. Again, go to bondstreetmortgage.com/agents. James, you don't mind, right? If somebody just texts you if they need something in a hurry, have a question.
No.
I put James's cell number right there. And James has a number of advisors at Bond Street who know this stuff really well. So I'm sure you'll either personally serve the business or hook an agent up with somebody they can partner with on these types of loans.
Absolutely. Be glad to.
Okay. Thanks, James. I'm going to go ahead and hang this up now. And everybody, again, remember, go to bondstreetmortgage.com/agents for more stuff like this.
See ya.
Yeah.